Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello everyone. Today we begin with the standard SA 510, which is Initial Audit Engagements, Opening Balances. So I repeat, it is SA 510, which talks about Initial Audit Engagements, Opening Balances. This is one of the important standards that we have and very interesting standard. It becomes very interesting because here you are going to come across a new term which is called as the Initial Audit Engagement, and this is something that you can relate and you can understand very well. Alright, so let us understand first what you mean by the new terms that you come across, and then we'll get into detail of what the standard is talking all about. First of all, to begin with, you need to understand that it is a conditional standard. Conditional standard as in, only if it is an initial audit engagement, only then the standard will become applicable. So you need to understand what you mean by the term initial audit engagement. Alright, now we have studied SA 210 where we spoke about recurring audits. So what do you mean by the term recurring audits? Meaning is that you are the auditor of the client for a particular year, and next year you continue to do the audit of the same client, right? So the audit firm and the client remains the same even for the next year. So in the next year, this term we call it to be what? A recurring audit, where the same auditor and the same client is continuing the relationship, that is the engagement has been continued, right? So in the same manner, we have something which we call it to be initial audit engagement. Now with the word itself you can understand, it is initial audit engagement. What is initial? Beginning. That is for the first time you are going to do the audit of this particular client. Let us assume an example of maybe X Limited and you are the auditor. So suppose last year you had done the audit of X Limited. This year also you are doing the audit of X Limited. That means the standard is not applicable at that point of time. We are telling that it is your initial audit engagement. First time you are going to do the audit of this particular client X Limited. When you do the audit for the first time of X Limited, that means it is first year of audit where you are going to accept the engagement. We call it to be an initial audit engagement. So maybe we are in the year 1920. So there is a possibility that for the year 1819, somebody else had done the audit of X Limited, and now we are going to do the audit of X Limited. On the contrary, there is one more possibility that previous year there was no audit only conducted of X Limited, and we are doing the audit for the first time of X Limited. In both these cases, we term it to be initial audit engagement, right? So once again, for your understanding, what is initial audit? When the auditor is been appointed for the first time. That means you are becoming the auditor for the first time of the client. Alright, so it is your new engagement on the simple language. For X Limited, either there was some other person who did the audit earlier, or X Limited is getting its accounts audited for the first time. In both the cases, we call it to be what? Initial audit engagements, right? Now having understood the meaning of the word initial audit engagement, let us continue the statement given in the standard name. What they say? Initial audit engagement, opening balances. Right? Now, this standard gives the responsibility to the auditor that when it is the initial audit engagement of that particular auditor, he has responsibilities towards the opening balances of that particular year. So let us talk about the year 21-22. So you have been appointed as the auditor for the first time of X Limited, and the year that we are going to audit is 21-22. Alright, now tell me, in the year 1920 or maybe 2021, okay, there has been an audit conducted. This audit was conducted by some another auditor, which we call it to be a predecessor auditor. Alright, now, so in the year 2021, audit was conducted and the report was generated. Now you are doing the audit of 21-22. So you have to give the opinion of the financial statements on the year ending 31st of March 2022. So obviously you understand that you have to take into account all the transactions that have been affected this year and all the closing balances which have been there in the balance sheet, and you are going to give the opinion. But now tell me, whether you want to give opinion on the balances appearing in the balance sheet or for the transactions which have affected during the year, don't you think it becomes very important for you to first ensure that the opening balances are correctly recorded? That means there should not be any misstatement in the opening balances. Opening balances should not have anything which would affect the current year financial statements, right? Therefore, in a very simple line, initial audit engagement simply says, or SA 510 simply says, that the auditor who is going to do the audit for the first time of this client is having certain responsibility towards the checking or the verification of the opening balances. What are opening balances? Simply to understand, closing balance of the previous year is going to be the opening balance of the current year, right? And how do you get closing balances? Very simple. You have opening balance, some additions, some deletions, and then you have the closing balance, right? So what we have, the opening balance which is brought forward, then you will have additions or deletions which are the transactions affected during the year, and then you will be having what? Closing balances. Now tell me, if you check the transactions, if you check the closing balance, and if you do not check the opening balance, by any way will you be able to give a reasonable assurance that the financial statements are free from material misstatement? No. Because when the beginning will be wrong, ending is obviously going to be wrong. If the beginning is correct, then we can believe, yeah, we'll check the transactions and then we can tell whether closing balance reported is correct or not. Correct? So it is very important for us to understand that when we do the audit of a particular client for the first time, then our duty is not only towards the transactions during the year or the closing balances appearing in the balance sheet. It is also important for us to understand and check whether opening balances are also correct or not, right? Because if the beginning is wrong, how will the end be correct? If you take, for example, the closing stock, the closing inventory of the previous year is obviously going to be the opening stock of the current year. If the opening stock is wrong, what is the reason of you checking the closing stock of the current year? Because what is closing stock? It is after all the calculations and all the transactions which we are going to add and delete to the opening stock. If the opening stock reported is having misstatement, closing stock 100% is going to be misstated, right? So this standard very clearly gives the responsibility that auditor, when it is going to be your initial audit engagement, you have a responsibility to also ensure opening balances are correct. Because when opening balances are correct, only then we can tell that the reported closing balances, whether they are free from material misstatement or not. When you want to check the transactions happening during the year, you would be able to give an understanding that yes, they are free from misstatements if you know the beginning of the transaction, that is the opening balances, right? So the name of the standard is very simple, which will now make 100% sense to you. That is initial audit engagement, opening balances. So it is the responsibility given to the auditor that in your initial audit engagement, you have a responsibility to have some kind of checking done on what? The opening balances. Alright? So this is what? Responsibility on the opening balance if it is your initial audit engagement. And for repetition purpose and for you to understand properly, what is initial audit engagement? When you are going to do the audit of a client, this is your first year with that client. Previous year, somebody else had done the audit. So maybe I am the auditor for the current year, and previous year maybe Mr. Z had done the audit. So Mr. Z will be called as predecessor auditor. I am called as the current year auditor, correct? And for me, it is an initial audit engagement. So when I check up the transactions for the current year and the closing balance of the current year, for me to give a report as on 31st March 2022, then in that case, I have to ensure the previous year's closing balances, which are this year's opening balances, whether they have misstatements or they are free from misstatement. Because ideally and very clearly you all can understand, when the beginning is wrong, ending will 100% be wrong. When the beginning is correct, then you could have a checking done on the transactions for the year and then you can give an opinion on the closing balance. Otherwise, there is no point in simply checking the transactions during the year and giving an opinion on the closing figures. Absolutely makes no sense. If the opening balance are wrongly brought forward, if the opening balances have a misstatement, correct? So this is about the introduction of the standard, which is entirely in the name, which is giving the responsibility of checking the opening balance when it is initial audit engagement. One more important point. There is also a possibility for initial audit engagement when previous year audit never happened. That means this client is getting its accounts audited only for the first time. Are you understanding? So when you are getting your accounts audited for the first time only, then obviously it is going to be my initial audit engagement. So both the things are possible. Either previous year somebody else did the audit, which we call it to be predecessor auditor, where audit report also will be available. And there is a possibility this client never got the accounts audited. Like there could be a sole proprietorship business which did not require to get its account audited. So the previous year they didn't get the accounts audited. So current year when they are requiring their accounts to get audited, they did not have any previous year audit. So this time also when I take up the audit, it is what? Initial audit engagement. And then the standard will become applicable on me. And then the standard says what? Look, auditor, you have a responsibility. It is your initial audit engagement. And because it is your initial audit engagement, you have a responsibility to ensure opening balances are correctly recorded. Clear? So now we are going to understand further in detail what you mean by exactly the terms opening balances, and then we will ensure how will the auditor check how is the correctness of the opening balance. Now, let us take an example for us to understand the concept even better. Assume I am checking the closing balance of the debtors. The debtors balance appearing where? In the balance sheet. So I am verifying the amount of debtors. It is my initial audit engagement. So for the debtors, I have taken up all the credit sales for checking. I have taken the bank statement for cross verification of the receipts which have happened during the year. And with that, I am coming to the closing figure of the debtors. Tell me, if you were in my place, would you call this to be correct procedure or correct method of checking debtors if it is my initial audit engagement? No. Reason being, credit sales during the year I check, no problem. I check the transactions in the bank book to understand what are the receipts, agreed. With this closing figure, I will not be able to understand accurately because I have a responsibility to check the opening balance of the debtors, which is nothing but the closing figure of the last year. So I will first check whether the opening balance of the debtors is correctly brought forward or correctly been recorded. Is there any misstatement in that number? And if there is, then I will do the checking of that, then check the transactions of the credit sales, then cross verify with the bank transaction. Only then I will be in a position to give the conclusion whether debtors appearing in the balance sheet, whether they are correct or they are misstated. Clear? So that is what we tell what? That it is opening balance verification required. Otherwise, you can never give a closing balance a reasonable assurance. Clear? Now, let us understand what the standard is actually asking the auditor. The standard tells that the auditor is required to obtain sufficient appropriate audit evidence with respect to certain things appearing in the opening balance. First, that means the auditor of the current year. In my example, the current year auditor is me. So when I am taking up the audit this year, my responsibility as per the standard is I should obtain sufficient appropriate audit evidence to check whether is there any material misstatement in the opening balance. Is there any material misstatement in the opening balance which will have an impact on my current year financial statement? And understand, when opening balance has a misstatement, closing balance will 100% have a misstatement. Because what is closing balance? Somewhere the calculation added, subtracted from the opening balance, right? So if the opening balance is wrong, closing balance will get affected. So the current year figure also will get what? Affected. So the first responsibility given to the auditor is, you have to ensure, that is to obtain sufficient appropriate evidence that the opening balance does not contain a material misstatement which is going to have an impact on the current year financial statement. Correct? For example, if you take inventory, the closing inventory and the opening inventory is rightly brought forward so that this year closing stock should not get affected by it. Right? Then, Second point is also very interesting here. Now we all know about the fundamental accounting assumptions. We have accrual, going concern and consistency, right? So we study about what? Fundamental accounting assumptions. There one of the important assumption is consistency, which we corresponded to what? The accounting policies. Now we know very well that the accounting policies have to be consistently applied year on year, correct? That means the accounting policies cannot undergo changes every year. This year this, next year that, no. So accounting policies have to be adopted consistently from year on year. So now the second duty as per the standard given to the auditor is that the auditor will obtain sufficient appropriate audit evidence that the appropriate accounting policies have been consistently followed even in the current year. That means what you followed previous year, the same is brought forward in the current year and has been consistently applied. That means first of all, appropriate accounting policy, correct accounting policy relevant in that situation is consistently applied even in the current year. And understand consistencies with what? Previous year and the current year, right? When both the years are corresponding, they are matching, we call it to be consistent. So last year brought forward this year means only it is consistent, right? So as per this standard, it is important for the auditor to obtain sufficient appropriate audit evidence that appropriate accounting policies have been adopted and have been consistently applied even in the current year. Now, what happens if the accounting policies are not followed in the current year? It is not that you are banned from not changing. There are certain reasons given in AS-A1 where you are allowed to change the accounting policies. Like for example, you require a better presentation. It is required by the statute. Then in that case, you are allowed to change your accounting policy. But when you change the accounting policy, you have to account and disclose for it correctly. So you as the auditor have to ensure two things. First is you see whether accounting policies are appropriately used and consistently applied. And suppose if they are not consistently applied, then they should be properly adjusted, properly accounted and properly disclosed in the current year financial statements. Clear? So this standard gives a very clear indication what is the responsibility of the auditor in an initial audit engagement. What is that? Two things. Both are connected with what? Opening balance. First thing says, look auditor, opening balance should not contain a misstatement which is going to affect the current year figures also. Correct? Second, accounting policies which were used previous year have been consistently brought forward even this year. Suppose if there is a change in accounting policy, then the auditor should ensure what? That they have been properly accounted for and disclosed as per the applicable financial reporting framework. Which financial reporting framework? The applicable one. So AS1 clearly gives an indication that you have to disclose correctly. If there is financial effect, you have to give a proper accounting treatment for it. Right? So this is what is told in the standard. So once again, two things. So auditor should obtain what? Sufficient and appropriate audit evidence regarding two things. One, no material misstatement should be present in the opening balance, which will have an impact on the current year. And about the accounting policies, first ensure they are consistently applied. If not applied, whether properly accounted and disclosed as per the applicable financial reporting framework. So what are opening balances? Very simple. Opening balance would be the closing balance of the previous year which is brought forward in the current year. That is the opening balance. What does the opening balances indicate? That these are all the transactions and the events which have happened in the prior period, and based on the accounting policies adopted on them, we have now the figure of the opening balance. So they are simply the reflection of the previous year financial statement data. So this year opening balance figure is like a reflection of the past year events and transactions that have happened based on the events and transactions and the accounting policies that you have adopted that time. All the calculations together is the opening balance, which is nothing but the closing balance of the last year. One very important point for you to understand, when you talk about opening balance, you not only see the numericals, you will also see the disclosure requirements. So some of the disclosure matters also become a very important element for the purpose of audit. Like we have disclosures regarding the existence of contingencies, contingent liabilities, commitments that you have, right? So these are all also brought forward, right? So this also becomes very important for the auditor to check as a part of opening balance, because opening balance includes matters which are in the disclosure requirements as well. Clear? And one more important term that we use here repeatedly is the predecessor auditor. Predecessor auditor is the auditor which belongs to the previous year. He is an auditor not from our firm. I am the current year auditor. He is an auditor from other firm and he has done the audit of the last year of the client. In my example, the client is X Limited. So maybe it is Mr. Y who has done the audit of X Limited. Current year, I will be doing the audit of X Limited. So I have been replaced. Okay, I'm sorry. Mr. Y has been replaced by me. So that Mr. Y will be called as what? The predecessor auditor. In very simple language, last year auditor who is not continuing this year, whom I have replaced this year, will be called as what? Predecessor auditor. Having understood the fundamentals of the standard, now let us go on into the detailing part, which is extremely simple, very logical and quite understandable. Alright? So let us understand what are the audit procedures adopted by the auditor for the purpose of obtaining audit evidences in order to ensure that the opening balances are correctly recorded. So here we are going to talk about what? The audit procedures adopted by the auditor, which is required by the standard. And here we are obtaining what? Sufficient appropriate audit evidence with respect to the correctness of the opening balance and about the accounting policies being consistently applied, and if not consistently applied, whether they are properly adjusted, accounted and disclosed as per the applicable FRF. Now let us understand the audit procedure. First one, we are doing audit procedure with respect to checking the opening balances, right? Now, first, what you will do is, you will take the recent financial statements which have been audited. So we are in the year 21-22. So we could take the previous year financial statements which have been audited. So 2021. So obviously when they are audited, audit report also will be available. So we could have a look at that and understand about any kind of information which would be relevant for us to understand if there is any kind of misstatement in the opening balance. Because the previous year has been audited and the audit report is available. So when that is available, we could have a look at it and we'll be able to understand, did the previous year auditor give any kind of understanding about a misstatement or any kind of error which was present in the balances or anything, which would be an indicator that the opening balance would have a misstatement. So you could read the previous year financial statement, you could read the previous year audit report which has been prepared, and all of this when you check, you will get an indication of some of the information which could be relevant for you. If no information is there, that means you could come to a conclusion or maybe at least an understanding that maybe there is a no misstatement in the opening balances. So first thing what you will do is, the recent financial statement which have been audited, you will take it. Those along with the audit report you will check for any information which you could find which would be useful for you. Alright, now. Second is, the standard is telling us that we need to obtain sufficient appropriate audit evidence with respect to understanding that there should not be any material misstatement in the opening balances, which is going to have an effect on what? The current year financial statement. So for this what we will do? That means what are we doing? We are checking the opening balance and we are obtaining evidence that the opening balance should not have any misstatement which is going to affect what? The current year financial statement. So for this what the auditor can do? First thing, the auditor should ensure that the last year closing balances have been properly brought forward in the current year. Copy paste should happen properly in simple language. Debtor last year 5 lakhs, opening balance of the debtor should also be 5 lakh. So there should not be arithmetical error also. There should not be an error of commission omission. All of these things should not happen. So you should first ensure that previous year figures have been correctly brought forward in the current year. This brought forward is also very important. If copy paste does not happen correctly, system will go wrong, entire year financial statements will give a wrong result. Understanding? So the first thing what the auditor will do is what? he will ensure that they have been brought forward correctly. Second, you have to ensure that the opening balances are being brought forward and there have been appropriate accounting policies used and they have been consistently applied in the current year as well. That means appropriate accounting policies have been used. That is the second thing that you are going to check. Third is that you are going to adopt certain specific audit procedures. So what is the first procedure? That we are going to check whether closing balance has been brought forward correctly in the opening balances. Very importantly, understand, you also have to ensure that if there has been a misstatement in the previous year, which has got corrected in the current year. So we call them to be what? Prior period items. So sometime rectification will happen and you adjust the prior period items in the current year P&L account, statement of profit and loss. So the auditor should ensure that that also is done correctly or not. Correct? So the first thing what you will do? Copy paste. Second, whether appropriate accounting policies are reflected in the opening balances. Correct? Now, third is they are telling we could follow any of the following three methods. They have given us three methodologies and they have told any one or two of them you can follow to obtain evidences regarding the opening balance. Alright? Under that, first one they talk is about pursuing the audited financial statements and the audit report of the previous year. That means what? Obtain the audit report and the audited financial statements of the prior period. With that you will get some of an understanding of all the closing balance details. Audit report will give you some relevant factors so that you can take into consideration. Clear? Then, second they tell that you have to check whether the audit procedure that you are adopted for the current period, is that going to give you any kind of evidence regarding the opening balance? Sounds very tricky to understand, but let me give you an example you will follow. I am telling that you have to see whether the audit procedure that you are adopting in the current year, the regular audit procedure that you are adopting, is that giving you any kind of evidence regarding the opening balance? That means for the opening balance, you don't have any other specific audit procedure to be followed. You are following some procedure for the current year alone. With that you are getting an evidence for what? Opening balance. For example, suppose in the current year there has still not been or there has not been any sales. Correct? There have not been any sales. But then when you look at the bank statement, you saw that there has been receivables. There has been a receipt which has been recorded. Now this receipt which I am checking, when I am obtaining the confirmation about these receipts, when I am performing the audit procedures on the receipts which are appearing in the bank statement, during the year, I understood that there has been some debtor balance existing in the beginning of the year. Because current year sale has not happened. Due to some reason, there has not been a sale which has happened during the current year. So when sale has not happened, from where will the receipt come? Right? But when I was checking the receipts as a part of my current year audit procedure, so when I checked the receipts, I realized with this receipt, that means there has to be an existence of opening balance of debtors. With that, I'll be able to understand that the opening balance of the debtors is existing. That means there is a right of this entity to receive money. There has been sales which have been taken place. So all of this is what I'll be able to understand. The valuation of debtors also I could understand, depending upon the receipt that is there. Correct? So this is not what I performed on the opening balance. This is basically I performed where? On the current asset, that is where the cash balance and all, where indirectly I got an understanding of the evidence, or I obtained an evidence regarding an opening balance figure, which is about the opening balance of debtors. On the similar lines, you could also take about purchases. Suppose during the year, no purchase you have made. But in the bank transactions, you can see there is a payment entry. Now, when there is a payment entry and there are no purchases, obviously it's an indication that in the current year when purchases did not happen and you are verifying the bank transaction, you have seen a payment is made to the supplier. And this audit procedure which you have adopted, and maybe when you obtain confirmation from the supplier, you realized this is what? Something relating to the opening balance of the creditors. So this audit procedure which you followed during the year as your normal audit procedure for the performance of their audit gave you evidence regarding what? Opening balance, correct? So these are usually for what? Current assets and current liabilities. So when you check the account receivables, account payable balances, usually automatically you will be coming to an evidence with regard to their opening balance as well, correct? Yeah. Third one talks about is what? Specific audit procedure. When I told you about current liabilities and current asset, then did we apply a specific audit procedure on the opening balance? No. We did the routine audit by checking the bank transactions, and in the flow we obtained evidence for what? The correctness of the opening balance as well, or something, an indication to the opening balance. Particularly on the opening balance we didn't do anything, correct? But third method they have told you is about specific audit procedure. Specific audit procedure usually is for the assets, fixed assets, or maybe liabilities, loans and all, long-term loans, wherein you cannot have any kind of other checking done as a routine process to understand their opening figures brought forward. So here you will apply specific audit procedures, like you could obtain external confirmation from the third party, like from the lenders, to understand what was the opening balance or what is the current year opening balance to be recorded. So here you are going to particularly apply specific audit procedure to ensure their existence, to ensure their valuation, to ensure the rights, to ensure the obligation. You have to perform specifically for that particular asset. Like for example, if you want to check about the loan, you could check the loan agreement. Specifically, you are going to check for the purpose of understanding what would be the opening balance as on that particular date, right? So what we understand here is the audit procedures. Usually what we do is, first thing, we are going to take recent year financial statement, usually the prior period, the last year, and if there is a corresponding audit report, we are going to check and see if there is any relevant information for us which will give an evidence regarding the opening balance. Then we also have to ensure that the opening balances should not contain material misstatements. For that, three things have been told to us. First, you will check that the closing balance of the previous year has been properly brought forward in the current year. Closing stock of the last year should be the opening stock of the current year. Copy and paste has to happen correctly, correct? Second, opening balance should reflect appropriate accounting policies. That means it should give an understanding that accounting policies which have been adopted are appropriate in the given circumstances and they are consistently applied. Under third they are giving you multiple options again. So in third what they are telling you is that we will give you three things. Any of the three things also you can apply to obtain evidences regarding what? Opening balance. These three they are, first one they say, pursue the audit report or the audited financial statement. Read it, understand it, that is inspect it and understand, do you get any evidence regarding the opening balance? Clear? Second they are telling, do not specifically perform something for opening balance. There are certain procedures that we will perform as a part of the current year audit only, but that will enable the auditor to obtain evidence regarding opening balance. Basically, this happens for current assets and current liabilities, which I gave you the example and you understood, right? Third, they are telling, perform specific audit procedure. Like for example, specific means what? For a particular item to ensure the opening balance, you perform a procedure. Like loan, a particular item, whether it was there, what is its value, was it the real obligation of the entity, what is the security, all of that you have to understand about the opening balance. So in that case, you will perform specific audit procedure. What is that? Maybe external confirmation. You could directly contact the banker and obtain a confirmation from them regarding what was the opening balance of your balance with us. That means what was the liability that this client owed you in the beginning of the period. So this is a specific audit procedure that we are going to follow, correct? Usually this is for fixed assets and for liabilities, long-term liabilities and all, where specifically you are going to adopt the procedures to understand their existence, rights, obligations, valuation, etc. Correct? So these are the audit procedures which we adopt for the purpose of understanding the correctness or to ensure or to obtain evidence that there is no material misstatement existing in the opening balance. Now, after performing these audit procedures, assume the auditor has come across a misstatement. Alright? Now, misstatement as in maybe he was checking the debtor's balance or he was checking the closing stock balance, that is the opening stock of the current year, and he realized there has been some kind of overvaluation or undervaluation, or maybe there has been some kind of misstatement in the brought forward figures. Alright, now in that case, the auditor has to adopt additional audit procedures to understand what the misstatement is all about, to understand whether that misstatement is going to impact the current year financial statement. Like for example, if there is an overvaluation of the opening stock, obviously it is going to impact the current year profit. So this is the additional procedure adopted by the auditor to ensure that how is it affecting the current year financial statement. If the auditor concludes that because of such misstatement, the current year financial statement is getting affected, that means overstatement of the opening stock is obviously going to affect the current year also, right? So in that case, after understanding that yes, it is going to affect the current year financial statement, then it is as good as misstatement identified during the year only, correct? So this overstatement which is belonging from the previous year to the current year, now when you understand in this year and you have settled the fact that yes, there is a misstatement, then which standard you will apply? It's a misstatement identified, right? Then you will follow the procedure as given in essay 450, evaluation of misstatement identified during the course of audit. So what happened? During the course of our audit, we have now identified a misstatement. So we need to communicate to this to management, to TCWG as per which standard? SA 450. So very simple, the standard says, look, after performing the audit procedures, if you obtain evidence that there is going to be some kind of misstatement, or if you analyze there is a risk of misstatement in the opening balance, you will perform the additional procedures to identify and settle the fact whether misstatements are there. And if finally you conclude that misstatement is present, then in that case, you have to evaluate the misstatement identified during the course of the audit. That means which standard will become applicable? SA 450, which tells you have to communicate this matter to the management and the TCWG as appropriate. Now we have understood about what will be the audit procedures which the auditor will adopt for the purpose of identifying misstatements in the opening balance. But the second part of the standard also talks about accounting policies. So with respect to opening balance, it is important for the auditor that he will obtain sufficient appropriate audit evidence regarding whether the opening balances are reflecting appropriate accounting policies and whether those accounting policies which were adopted in the previous year have been consistently applied even in the current year. For example, valuation of the inventory or the method for valuation. So year on year you cannot change. 1 year weighted average, 1 year LIFO, 1 year FIFO, you cannot do that. So when you are doing the valuation, when you are going to do such kind of inventory valuations, they have to be consistently applied year on year, correct? So first thing, the auditor will obtain sufficient appropriate audit evidence with respect to the reflection of the opening balance with respect to appropriate accounting policy. That means what policy has been adopted is appropriate and it has been consistently followed from the previous year to the current year, correct? Then suppose if the management has changed the accounting policy due to some requirement, because we know we can change the accounting policies, but obviously there are some conditions behind it. It is not your choice. It comes by the law that when are you allowed to change the accounting policies. For example, if they are required by the statute, you can change. But whenever you change the accounting policy, then you have to appropriately disclose about it, correct? So you have to properly account for it and disclose for it. That means here the auditor will obtain audit evidence with respect to if there is a change in accounting policy, then the auditor should check that yes, these changes have been properly accounted, properly adjusted. Because disclosure very important. If there is financial effect, if any, that you have to appropriately adjust in the statement of P&L. It is very important that you understand these things. Only then the standard will be understood. When you are changing, there is going to be a financial effect which is definitely going to affect the profit also. So that financial effect, what change, everything you have to account for it properly, correct? And disclosure has to be correctly done. If you have accounted properly and you have disclosed correctly as per the applicable FRF, that also will be enough for the auditor to tell that yes, the opening balances have been correctly recorded, Clear? So what we talk about accounting policies? Two things. Appropriately applied, consistently applied. Second, if not consistently applied, then you have to check whether they are accounted properly and disclosed as per the applicable for financial reporting framework. Now I'll give you a scenario. Just try to analyze it and think over and tell me what would you have done, or just analyze and understand what you would have done in this particular situation. Suppose the previous year audit of X Limited was done by Mr. Y. So Mr. Y in our language is the predecessor auditor. Mr. Y has done the audit of X Limited. He completed the audit and he generated the audit report of the previous year. In that he has given a modified opinion. So he has either given a qualified, he has given adverse, or he has given disclaimer of opinion. Alright? He has given a modified opinion. Current year is your initial audit engagement. You are doing the audit of the current year. SA 510 will become applicable for you. So you have a responsibility towards the opening balance. So when you are checking and when you come across the previous year audit report, you saw there is a modification done to the financial statements. There is a modified opinion. If you are the auditor of the current year, what would you have done? Now, I am 100% sure you all must have understood where I am pointing at. That means, in the previous year audit report, if there is a modified opinion given, obviously, reason for modification also will be given. Correct? So, maybe debtors were wrong, creditors were wrong, or maybe there has been some kind of problem in the salaries, or maybe there has been some kind of problem in one of the incomes, or maybe investment valuation has gone wrong. There could be some kind of, or maybe valuation of inventory has got considerably wrong. You have done maybe a wrong usage or wrong application of accounting standard 2. So there has been some kind of material misstatement because of which the report has been modified. And the reason for modification will always be given where? In the audit report. We will have a paragraph which we call it to be basis for modification, where the auditor has to clearly give the reason why he has given a modified opinion. Now you have the financial statement in your hand and you have the audit report also in your hand. You are reading the audit report, and when you are reading, you understood it is what opinion? Modified opinion. So you went to the basis for modified opinion paragraph, and there you saw that inventory is materially misstated. Got it? Now, tell me, in the current year also, will you not double check or will you not cross verify whether the inventory valuation has happened correctly or not? That means for inventory opening balance, are you going to consider it to be an area of risk of material misstatement? When you do SA 315, identifying and assessing the risk of material misstatement, don't you think this is going to give you an indication that in the inventory's opening balance, there is a scope for material misstatement? Correct? So what you will be doing here is, you will go through the audit report of the predecessor auditor and you will understand what was the reason for the modification. And if you believe the reason of their modification by any chance is even happening today, if it is there today also, that means that misstatement is continued even today, then obviously your current year financial statements are also affected by it. So in that case, you are going to ensure whether those misstatements have been corrected or still uncorrected. So when you are going to do identifying and assessing the risk of material misstatement, this modified opinion, the reason for modification would be an indicator that this particular area, there is what? A risk of material misstatement. Now the last part of the standard talks about audit conclusions and reporting. That is what we are supposed to do at the end, right? After all the procedures, everything, the ultimatum is what? Our opinion. So let us discuss about various scenarios and what opinion will you be giving. First, this standard is telling us to obtain sufficient appropriate audit evidence regarding the opening balances. Suppose the auditor, after applying all the audit procedures also, is unable to obtain sufficient appropriate audit evidence with respect to opening balance. Then in that case, we will end up giving a qualified opinion or a disclaimer of opinion. Qualified if material and not pervasive. Disclaimer if material and pervasive. When you are unable to obtain sufficient appropriate evidence, when you are not in the position to give a reasonable assurance, then you have two options. Either you depend upon situation of pervasiveness, you will decide whether to give a qualified opinion or disclaimer of opinion as appropriate. Second, you have obtained sufficient appropriate audit evidence, and with those evidence you are concluding that the opening balances contain a material misstatement, and those material misstatements are going to impact the current year financial statements also. That means the misstatement of the previous year is affecting the current year also. So in that case, we will end up giving a qualified opinion or adverse opinion, whichever is appropriate. So qualified or adverse opinion, because we have obtained evidence regarding a misstatement being present. So in that case, we will give what? A qualified or adverse opinion. Clear? Now, next, we talk about is regarding consistency of accounting policy, and if it is not consistently followed, where you have to give up appropriate disclosure and the accounting treatment should be correct. That is also what is required by the standard, right? Suppose if the auditor obtains audit evidence regarding the fact that the accounting policies which are being reflected in the opening balance are not appropriate, or they are not consistently followed, or they are not followed and there has not been any disclosure given about it. That means you are not consistently following, and even disclosure has not been given adequately. Adjustments have not been made appropriately. Then in that case, you know very well, it's as good as material misstatement. So you are going to give what? A qualified or adverse opinion. Disclaimer obviously cannot come because you have obtained evidences. And when you have obtained evidences, the question of disclaimer will not come. So you will either give what? A qualified or a adverse opinion. Right? Now, third thing, we know, we have just now discussed about using the predecessor audit report. So in the predecessor audit report, there is a modification. This modification, that means the reason for the modification is still remaining uncorrected. It is still present even in the current year. That is, the misstatement has still not been rectified by the management even in the current year. It is still continued. There has not been any kind of prior period adjustment. There has not been any kind of rectification about the misstatement because of which modified opinion was given in the previous year. So that misstatement is continuing even today, and that is giving an impact on current year financial statement also. So in that case also what you will do? You will end up giving what? A modified opinion. So it will be a qualified or adverse opinion. Because when the previous year auditor has given a modified opinion because of that reason, and this year the reason is still continued, in that case what you will do? Like if there is an overvaluation of the closing stock, then this year also you will be having what? The same misstatement. So there has been certain adjustments that you do for bringing the stock to the normal level. But you are not doing, you are simply carrying forward the same figures. That means still there is an overvalued amount. This is a material misstatement existing even today, and this has an impact on what? Our current year financial statements. So we will also end up giving what? A modified opinion as per SA 705. So very simple. If you cannot obtain evidence, qualified or disclaimer. If you obtain evidence, qualified or adverse. And if you are relying on the predecessor audit report, and if that has a modification which has not been rectified, you will give the same opinion which was given in that particular report as per SA 705. So that is all about SA 510, Initial Audit Engagement Opening Balance. As I told you in the beginning, one of the simple standards that you have, understandability is very interesting because it is very logical, and this standard holds importance for the examination. So very important for you to understand. It is very less in quantum, so the quantity of studying is very less, very easy to grasp the concept, and remembrance also is very simple. So I would call it to be one of the simple, so a bonus standard, because in the examination questions are targeted from SA 510. So to end with, SA 510, Initial Audit Engagement Opening Balance. So we here spoke very clearly only about what? Opening balances, which is the highlighter of this topic.